It didn't begin with a crash or a dramatic announcement. It began with a feeling. By midweek, something about the global mood felt heavier, slower, less forgiving. Markets were open, numbers were moving, but confidence was thinning. In the United States, the damage wasn't immediately visible in a single index. It showed up in fragments, quiet sell-offs, cautious earnings calls, and a tone shift that traders recognized instantly. The cost came fast. Equity markets shed value across multiple sectors, but the real pain wasn't limited to stocks. Bonds wobbled, the dollar hesitated, and commodities stopped behaving predictably. Together, these moves pointed to stress rather than strategy. By Friday, estimates placed the loss near $50 billion. Not catastrophic, but enough to demand attention. What made the week costly wasn't the number itself. It was how quickly expectations changed. Investors who entered the week assuming stability were suddenly adjusting to uncertainty. Growth projections softened. Risk tolerance narrowed. Capital that normally moves freely began pausing, as if waiting for confirmation that never arrived. Behind the scenes, policymakers were watching the same data with concern. Inflation hadn't spiked. Employment hadn't collapsed. Yet the markets were acting as if a warning had been issued. This disconnect fueled anxiety. When behavior changes without a clear trigger, it signals fear of something still unseen. As U.S. markets struggled to find balance, attention turned overseas. Beijing didn't rush to respond, but it didn't stay silent either. Within days, Chinese officials issued statements emphasizing resilience and long-term planning. These weren't emotional reactions. They were calculated signals. China wanted it known that it had noticed the shift and that it wasn't unprepared. Currency movements reinforced that message. The yuan remained controlled, steady enough to project calm but flexible enough to send a subtle warning. Trade-linked assets responded quickly. Asian markets adjusted before Wall Street could fully process what was happening. This timing mattered. It suggested awareness, not reaction. For American investors, this added another layer of discomfort. The loss wasn't just domestic anymore. It was now framed within a global response. Beijing's restraint contrasted with U.S. uncertainty, and that contrast fed a narrative of imbalance. Perception began to outpace reality. Media coverage intensified the effect. Headlines spoke of pressure, of tests, of moments that could redefine economic leadership. Each article framed the week as a pivot point, even though the fundamentals hadn't fully broken. But markets don't wait for confirmation. They move on interpretation. By the weekend, the question wasn't how much had been lost. It was what had changed. Trust had thinned. Assumptions had cracked. And once that happens, recovery becomes harder, not because of numbers, but because of mindset. This was no longer just a bad week for the U.S. It was a signal. And Beijing had heard it clearly. Once the losses were acknowledged, the pressure didn't stay contained. It moved quickly, slipping through channels that don't show up on charts. The first place it appeared was behavior. Traders shortened time horizons. Long-term positions were rechecked. Conversations that normally focused on opportunity shifted toward protection. This wasn't panic. It was vigilance, and vigilance can be just as disruptive. In Washington, the response was careful to the point of restraint. Officials avoided dramatic statements, hoping stability would return on its own. But silence has consequences. In the absence of reassurance, markets fill the gap with speculation. Every delayed comment felt like hesitation. Every neutral statement felt incomplete. Confidence doesn't require certainty, but it does require presence. While U.S. policymakers weighed their words, Beijing acted differently. It didn't announce stimulus or threaten retaliation. Instead, it highlighted internal strength, manufacturing capacity, regional trade ties, and domestic demand. The message wasn't aimed at Americans. It was aimed at investors watching from everywhere else. China wasn't chasing headlines. It was shaping expectations. Supply chains reacted before governments did. Shipping data showed minor slowdowns. Commodity contracts adjusted slightly. These weren't disruptions yet, but they were anticipatory moves. When enough participants brace for impact, the impact often arrives anyway. This is how pressure turns self-fulfilling. American corporations felt caught in the middle. Multinationals exposed to both markets had to reassure shareholders without provoking either side. Earnings calls became exercises in careful wording. Executives spoke about flexibility, diversification, and contingency plans. Those words are rarely used when confidence is high. The cost of the week now extended beyond dollars lost. It showed up in postponed decisions. Expansion plans slowed. Hiring projections softened. Even small delays compound when repeated across an economy. Growth doesn't stop suddenly, it erodes quietly. Beijing's calm posture made these hesitations more visible. By refusing to escalate, China positioned itself as the stable counterweight. That image mattered. Markets don't just evaluate strength, they compare it. In that comparison, the US appeared reactive, even if its fundamentals remained solid. Investors began adjusting narratives. The story wasn't about collapse, but about momentum. Who was dictating the pace? Who was responding instead of leading? These questions shaped flows more than raw data ever could. By the end of the week, pressure had embedded itself into expectations. Even those who believed the sell-off was over began acting cautiously, just in case. That's how a single costly week stretches into a longer adjustment phase. What started as market movement was now a psychological shift. The numbers mattered less than the message people thought they were sending and receiving. And in that exchange, Beijing hadn't stayed quiet. It had chosen its moment carefully. By the time the third phase began, markets were no longer reacting to events. They were reacting to stories about those events. Numbers had stopped surprising anyone. What mattered now was interpretation. Every movement was framed as confirmation of something larger, something structural, something unavoidable. In the US, analysts began revisiting old assumptions. Growth wasn't disappearing, but it was being questioned. The idea that American markets could absorb shocks endlessly without consequence felt less certain. This doubt didn't come from a single data point. It came from accumulation. One uneasy week layered on top of years of stretched valuations and persistent policy tension. Beijing understood this phase well. It didn't inject drama into the conversation. Instead, it let others do it. Chinese state media emphasized patience, historical cycles, and long-term positioning. The tone was deliberate, almost detached. That distance itself became a signal. It suggested confidence in endurance rather than speed. Global investors noticed. Capital that had chased quick returns began rotating toward perceived durability. Infrastructure, energy security, and regionally anchored industries gained quiet interest. This wasn't a rush. It was a recalibration. The kind that happens when people stop asking how fast they can grow and start asking how long they can last. American markets struggled with this shift. Speed had always been an advantage. Innovation, risk-taking, and rapid scaling define the narrative. But durability requires a different rhythm. It favors planning over momentum. In this comparison, the US wasn't weak, it was exposed to a mismatch in expectations. Commentary amplified the tension. Some voices framed the week as a warning shot. Others dismissed it as noise. The disagreement itself became destabilizing. When experts don't agree, audiences default to emotion. Fear and confidence competed for attention, creating volatility even in otherwise calm sessions. Retail investors felt caught between these narratives. Many chose to do nothing, which paradoxically increased instability. Lower volume makes markets more sensitive to small trades. Minor moves feel larger when fewer participants are willing to step in. Silence becomes fragility. Beijing's refusal to escalate continued to shape perception. No threats. No sudden moves. Just presence. That steadiness contrasted sharply with the constant interpretation cycles playing out elsewhere. Stability, even performative stability, has weight. As the days passed, the story solidified. The costly week was no longer an isolated event. It became a reference point. Analysts spoke of before and after. Not because conditions had dramatically changed, but because awareness had. This is how narratives reshape markets. They don't require collapse. They only require belief. Once enough participants accept a new frame, behavior adjusts to fit it. That adjustment becomes reality. By now, the question wasn't whether the US could recover the lost value. It was whether it could reclaim narrative control. Beijing had not stayed quiet. It had allowed others to speak themselves into uncertainty. And in modern markets, perception doesn't follow reality. It leads it. When the week finally ended, nothing dramatic closed it out. No emergency summit. No decisive reversal. That absence was telling. The real aftermath of the costly week wasn't loud enough to trend, but it was deep enough to last. Markets reopened with restraint. Prices steadied, but enthusiasm didn't return. Investors behaved as if they were walking on recently cracked ice. Positions were held, not expanded. Risk wasn't abandoned, but it was rationed. This kind of caution signals memory forming. Markets remember how uncertainty feels. In the United States, the focus shifted toward reassurance. Officials emphasized strength, flexibility, and resilience. None of this was false. But reassurance works best when it arrives before doubt hardens. Now, it was arriving into an environment already shaped by interpretation. Confidence is harder to rebuild than it is to maintain. Beijing continued its quiet posture. There were no victory laps. No public pressure. That restraint reinforced the image it had cultivated throughout the week. By choosing not to escalate, China allowed the contrast to speak for itself. Stability doesn't need volume to be noticed. Long-term investors began separating signal from noise. Some saw opportunity in the pullback. Others saw reason to wait. This division slowed momentum. When capital disagrees internally, movement becomes cautious by default. The market didn't collapse or surge. It hovered. What truly changed was timing. Decisions that once took hours now took days. Capital approvals slowed. Strategic shifts required more justification. These delays don't show up immediately in headlines, but they compound quietly across systems. Global observers absorbed the lesson. The episode showed how interconnected pressure had become. A loss measured in billions could ripple through sentiment, policy expectations, and international positioning without a single formal confrontation. Power, it seemed, was no longer just about action, but about reaction management. For the US, the week served as a reminder that leadership is partly psychological. Markets look for steadiness as much as strength. When uncertainty appears, others will fill the silence. Beijing understood this. It didn't need to be challenged directly. It only needed to remain composed. The cost of the week wasn't confined to valuation. It was paid in hesitation, in slower confidence, in a recalibrated sense of risk. None of these are fatal, but they are cumulative. What comes next won't be decided by this single episode. It will be shaped by how quickly trust is rebuilt and how clearly direction is communicated. Markets forgive losses faster than they forgive confusion. In the end, the most lasting change wasn't financial. It was psychological. The US didn't fall behind, but it was reminded that momentum requires more than numbers. It requires narrative control. And that week proved one thing clearly: when pressure shifts, silence is never neutral. If this helped you understand what really changed, subscribe for more clear, calm breakdowns of global power and markets. The next shift is already forming.